So uh, this is the elephant in the room. I think this is the most important chart, and everything flows from this chart. I would like you to look at the data. First, the chart. What is the data? How much debt it has been required to grow how much GDP. Now, some of you would be running your own companies. If you would be needing so much debt to create only so much output, I'm pretty sure in few years you will go bankrupt. And that is what has happened to countries across the world. Over the past 2 centuries, 51 out of 52 countries that reached sovereign debt levels of 130% of GDP ended up defaulting within 0 to 15 years, either through devaluation of their currency, or through inflation, or through restructuring of debt, or outright national default. Argentina is a master of outright national default. They have defaulted on each and every debt in the last 30 years. US touched 130% after COVID. So US debt has grown 6 times in the past 25 years, whereas US GDP has grown 3 times. We are at 120% debt to GDP now. Now, US is not alone. Most of the Western countries are in a similar situation. So either you can default, you can devalue your currency, you can inflate your way out of it. What will the Western world choose will determine the fate of each and every asset class. For my screen, yes. So this is what I posted on June 28th, 2024, just 6 months before President Trump was inaugurated. So it was very simple. My view on US, if President Trump wins the election, a Trump win will be America First policy, which will accelerate deglobalization. It will push more countries to take care of their own security, as US military umbrella will not be freely available. A Trump presidency will be a transactional relationship. A Trump presidency will undermine institutions, especially Fed independence. Trump will want lower dollar, lower rates, and will erect massive trade and tariff barrier to protect American industry. Historically, it is a responsibility of the reserve currency to share its GDP and police world shipping lines. But America under President Trump will be more inward-looking, and that will lead to acceleration of multi-currency trading system. This was in 2024, a year, almost 15 months back, what I wrote about it. And the best part is, instead of President Trump, if it was President Kamala Harris, it would not have been different. It might not have been so dramatic, but it would not have been different. For the simple reason, US has just too much debt, and they want to get out of their debt. So I will continue, and this is where I built up my own thinking process. What will happen to if this is the world, and the world has continued going in the same direction? Here, in a cricket analogy, I would call it we are the first, possibly the second day of the 5-day cricket match we are here. So if world does not have a hegemon, if US is not going to police the shipping lines across the world, then what does it lead to? There is a very famous video of President Trump at United Nations, uh, and the German delegation was laughing at him when he was telling Germany, please increase your defense spending. That was, I think, in 2018-19, in his first term. And the German delegation was laughing at him. Fast forward 4 years, and you see what is happening in front of you. NATO countries outside of US, because US is not willing to take any more burden, have to spend more of their budgets now on defense spending, because US military umbrella is not freely available. And that is the brave new world, where suddenly these countries, which have already been spending huge amount of money on social spending, now have to carve out the budget to spend on defense. As you know, like me, that once you start doing social spending, you do not cut social spending to increase the defense spending. You actually increase the deficits to pay for it. And what is deficits? Deficit is actually borrowing from the future, and that is what the whole world around us is doing it. But deficits are good for few asset classes, and deficits are bad for few asset classes. Obviously, we will talk about those things. So there is absolutely no appetite for austerity. Government will have to give in or will be voted out. We saw it with when Elon Musk failed to cut spending through Doge. I was very, very bullish when Elon Musk was appointed on the board that he will do the Doge spending. And he himself said, I cannot do it. It is very difficult to cut bureaucracy. You know what happened in Lok Sabha elections in India. I will not repeat that thing. We have a Bihar election coming up. You know the kind of money which we are doling out. On the bottom right is where I had a ray of hope. Where Argentina market, where President Milei, he actually said, vote me if you guys are willing to take austerity. People voted him. But within 12 to 15 months, now he needs a bailout again because people cannot take austerity. And this is where I wanted to share what we have done it this year on the completion of 3 years. We have put out our hits and misses, 6 hits and 4 misses. When did we buy? What was the thinking process when we exited? I would consider Argentina as a hit till last month. And now with President Milei doing exactly what the rest of the world is doing, this hit Argentina ETF has turned into one of our misses now. So we bought it right. We thought he's doing the right thing. The currency had stopped depreciating. Economy had started doing well, and he lost few elections. And then they need a bailout, and US is going to give them a bailout again. So this hit in our portfolio turned into a miss, and we had to reduce the allocation sharply. Now, anytime you're looking at investments in Western world, they have something of 2% inflation. That inflation should be 2%. We should only be looking at 2% inflation. But if you Google it, what was the logic of 2% inflation? You will actually find, you'll have a smile at your face if you were to just ask an AI, okay, what was the logic of this 2% inflation? Just read the explanation and you will laugh. So, but having said that thing, think of a brave new world where the new inflation is not 2%, but the new inflation is 3%. I'm talking about the Western world. Think of it, what the world will change. So when Fed cut the rate last month, that was the first rate cut in 30 years with PCE, personal consumption expenditure, which Fed looks at. For the first time, it was at 2.9%, the inflation was there and Fed was cutting the rates. 60% of the US inflation basket is already running at 3%. And market is already believing that there are 2 more rate cuts coming. So they will not tell you, but it's the frog is in a boiling water and the temperature is rising. So we are slowly moving to a world where we are not being told, but us central bankers will have to start accepting 3% inflation as the new inflation, as the new 2%, simply because the Western world is too indebted. When the Western world is too indebted, then central bankers are no more independent. They are the extended arm of the government. And that's why I wrote when I wrote about President Trump, had it been President Harris also, Fed would have been an extended arm of the government. It would not have been an independent entity. Bonds. Bonds are certificate of confiscation in this brave new world. I will go back to 1944 to 1952 once. Why? There was only one time in US history where their debt to GDP touched 130%. That was 1945 when the soldiers were coming after winning the World War II. Between 1945 and 1952, the economic policies and the Federal Reserve policies led to US debt to GDP coming down to 70%. By 1952, their industrial production went through the roof. I believe we are seeing exactly the same template where they allowed the inflation to run hot, they capped the bond yields, they spend huge amount of money in industrialization. By 1952, 1953, they were back. But between 1944 to 1952, bonds were certificate of confiscation. That doesn't mean that you will not be paid out. You will be paid out on your bond, but the value of that bond will fall because the inflation will be more than the interest rate you are paid on that bond. So what is interestingly happening, and there's not too much focus what is going on in India, but Bank of England has reduced the long-term borrowing. France may need a IMF bailout. US has reduced the long-term borrowing. They are borrowing at the shorter end. Even India to cut long-term issuance as demand from insurance wanes. But who borrows at the shorter end? Who borrows in near term? Actually, it's the Latin American countries which are notorious for borrowing at shorter end because they do not have buyer at longer end. So has the Western world become a kind of Latin American country? I strongly believe that US is no more US. US is like an Argentina with a US characteristics. So what assets to buy? If US is no more a first world country, but Argentina. So we will discuss that thing, but it's a very interesting thing. You can buy short-term bonds, but a long-term bond, in my view, is a strict no-no. Although you might have few rallies coming here in between, but in the long term, bond bull market is over in my view. So we saw that thing, and there are enough ETF to play that kind of thing in global portfolios. There is a very interesting ETF, PFIX, which we bought. You saw there is an entry and there is an exit. It is like wallet. The way you have VIX for equity, the same way you have MOVE, MOVE for bonds. If you believe the bond volatility is going to rise, then you buy PFIX. So we bought it just ahead of time, and you know what happened in August 23. I think it was Liz Truss movement, where UK bond market went bidless, and at that point of time, we exited it. Even in a bond ETF, you could double your money in a matter of few months. So there are enough instruments, if you have a strong view, there are enough instruments in US markets through which, and in ETF form, through which you can express your view. So this is a very interesting chart from Sherwood. You all know US is a consumption economy. 70% of US GDP comes from consumption. But something very strange happened last quarter. The AI spending in US economy overtook the spending from consumption economy. If AI spending would not have happened in the last quarter, then US GDP would have been negative growth. So I do not have a view on AI. Yes, it is game changing. We are talking about investments. Cannabis is game changing. In 2000, internet was game changing, and it improved the life. But what happened to stocks after that? So exactly the same way. But today, US economy is no more a consumption economy. It is actually an AI spending driven economy. But for the last 2-3 years, I'm writing only on one subject, which is electrification. The US wants to manufacture, India wants to manufacture, Elon Musk wants to come out with robots. And now you have data centers. Everything is good. Everything is fine. Where is the electricity for that? There is just no electricity. And plus, we've spent so much money on solar and wind, but these are intermittent energy. they have to be put on grid, and US grid is 25 years old. Yes, nuclear is the future, but you don't build a nuclear power plant in one day. It takes 8 to 10 years to build a nuclear power plant. So if anybody is interested in AI and believes AI is the future and it will happen, then picks and shovels are the right way of playing it. So this OpenAI and NVIDIA AI plan requires 10 nuclear power plants to be built. Just for information, till 6 months back, there was not even a single nuclear power plant in US under construction. The highest amount of a nuclear power plant under construction, number one was China, second was India. Something about US, you all know what happens in background. It started with Iraq because Iraq wanted to invoice its oil in some other currency. Then it moved to Iran, again resources, Syria, again resources, Russia, again resources. And now I believe US shale revolution is coming to an end. So just how big was US shale revolution? Between 2009 to 2023, in 2009, US oil production was 6 million barrels per day. By 2023, their oil production was 13.5 million barrels per day. US created an entire Saudi Arabia in those 10 years. But US shale production is not like traditional oil wells. They have to be drilled very, very fast, and then you move to another assets. So US shale production is coming to an end. That means the US shale revolution is coming to an end. If US shale revolution is coming to an end, then they need new oil. So whatever you are hearing on Venezuela, and Venezuela is the backyard of US. I believe the next country where US will invade is going to be Venezuela. And obviously the pretext will be completely different, but it has to do with only resources. If it was a country, barren country without any resources, US will never ever send its, spend so much time on that. But all because US own shale revolution is coming to an end. And that's why these guys are even going for offshore drilling back. A little bit, I'll not spend time on stablecoin separately because I'm still building my knowledge on stablecoins. But think of it this way, that Western world, what is stablecoin for Western world is gold for BRICS. The simple reason, 70% of the gold in the world is already in the hands of BRICS country, or over the last 20 years has been shifted from Western world to the BRICS country. You can see on the right, the largest producer of gold in the world is China and Russia. If US is no more the reserve currency, because of all the reasons which I have given in the second slide, then you would want something else to take its place for the time being till the time we have a reserve currency. Western world cannot accept gold simply because the two largest producer in the world are China and Russia. And most of the gold is with BRICS country. So Western world wants its own currency in which it can trade. I believe within next 5 years, we will have two separate trading blocks. One is led by US, where all the international transactions will treasury bonds. So in next 5 years, let's say you are an exporter and you are a part of US block. When you export to US, you will no more be getting US dollar. You will be getting a US stable coin in an app with you, and those stable coins can be traded with anybody else. So, and it will be bypassing the banking system completely. US will know at any given point of time who is owning stable coins and how many stable coins are being owned. So this is a part where US will decide, I do not want these countries to be a part of stable coins, so they will not get stable coins, or their stable coins will block if they take it. Already in Brazil, stable coins, US stable coins are being traded at a premium because people in Brazil do not believe in their own currency. So they say we are better owning stable coins, US stable coins, rather than Brazilian real. So they are already trading at a premium in Brazil. You can already see the US stable coins are now a $500 billion market. Sorry, $300 billion market. Now, something on the right, we do not trust Chinese currency. Let's say it's BRICS. We do not trust Chinese currency. We do not trust Russian ruble as Indians, or nobody trusts. So Saudi Arabia I will talk a little bit more on the next slide. But let's say Saudi Arabia exports oil to China, and China has nothing to sell to Saudi Arabia. I'm just giving an example. So China will give CNY to Saudi Arabia uh, because they want to bypass dollar. Saudi Arabia says, I do not want your CNY. Obviously, nobody will want CNY. China will say there is a Shanghai Metal Exchange, which is there in Shanghai. You can convert this CNY into gold, put that gold on a plane, and fly it to Saudi Arabia. Already these kind of transactions are happening. I will talk a little bit more about that thing. So a time is coming, and you need to be prepared for that you will have two separate systems simply because we are back into Cold War. The way China is standing up to US. China has the leverage over here in my view. So Chinese understood in 2013 that US will not allow it to become a superpower. Slowly in 2013, starting 2013 itself, they started selling their US treasuries to buy gold. Can you hear me?
Yes, Hitesh, we can hear you.
Yeah,
Yes.
okay. Sorry about that. So 2013 itself, they understood that US will not allow us to become a superpower. And if we hold too much of US dollar, then US has the leverage on us. So you can see the line, the white line on the red, on the left side, left chart is the gold accumulation by China. And the red line is their holdings of US Treasury. And something very big happened this year, a trend change after 30 years. Central bank gold holding versus US Treasury holdings. We all understood in 2022 what is going to happen when we got a shock of our life as a central banker, if I was sitting as a central banker, when Russia's foreign exchange reserves was sanctioned and confiscated by G7 countries. Think of it in this way. India has what, $700 billion of FX reserves. FX reserves don't lie in India. If it is a USD denominated, it lies in US with one of those US banks, JP Morgan, they have the custody of US treasuries if we hold US treasuries. So if tomorrow India is not in good books of US, then US can sanction and take away India's FX reserves. That was the day in Russia-Ukraine war, every central banker got a doubt. But actually leave it to Chinese, they knew in 2013 itself. India got a hard knock this year. So already India's holding of US treasuries have started going down. Now think of it this way, if more and more countries do not believe in US dollar and also know that the country is on a fiscal wreck, it will continue to increase its supply of paper, whereas the supply of gold above the ground is not rising, then you have central bankers which are now not buying US treasuries, but buying gold. As per some of the really smart people I follow, they say in the next 5 to 6 years, gold will be the currency of central bankers and will be completely out of retail hand, will be so costly. It will be used only for international trade settlement. And maybe a time will come where it will become so illiquid for it to be traded so freely by retail. I have no understanding at this point. But the whole view is that what you've seen in gold till now is nothing if gold is a new neutral reserve asset. So this was I was talking about, that you have this much China gold at exchange. So if you are exporting anything to China and you have nothing to import from China, you can go to Shanghai Metal Exchange, convert it into gold, put it in your vault. So now China is opening a vault in Hong Kong with 2,000 tons of gold, and China is opening a vault in Saudi Arabia, and telling which will be operated by China only. It will be in Saudi Arabia, but will be operated by China, where the gold will shift from one vault to another vault as a trade settlement for anybody exporting. So if you do not want to keep your gold in China, you can put it in Saudi Arabia. I am hearing rumblings of a gold vault being put in India also. There are so many countries which will be uncomfortable with Saudi Arabia or Hong Kong and Shanghai, but could be very comfortable keeping their gold in India as a third party, because India is a neutral country. So there is a lot of things happening under the surface. China is very notorious for not giving out full information out over there. So anything you take it out with a pinch of salt. But these numbers don't lie. So the numbers are there in front of you. And it's very interesting developments happening around us. Simply because all of us wants to bypass, not us, it's a BRICS country which wants to bypass the USD. This has been our best call for the fund. As soon as the fund started, gold became our top holding. And how do we buy gold? It is GLD ETF through which we buy gold. So that became our top holding, and it continues to be our top holding. Now there is a very interesting thing happening in gold. Gold becomes overbought very fast. You move very fast. So time comes where you say, everybody is into gold. We saw that thing many times in the last 3 years. Even in April, I'll give you a small example where we have this great example of shoe shiner telling you to buy gold or a pan wala telling you to buy gold. And that started happening in April. We reduced our allocation, that being pretty sure that we will get it cheaper. What is happening in gold for the last 2 years is time correction, not price correction. You're not able to buy it cheap, which makes it very, very interesting. Because normally you should get price correction. Most of the people are not allowed to be made money who are traders. That is how markets evolve. But these markets, they become overbought. They go sideways for 2-3 months. People forget about that thing, and then it is ready for the next leg up. That is exactly what I'm finding in gold. So selling gold to buy gold cheaper has not been a profitable thing for our investors. So we continue to hold gold, and we have to ride this volatility, because as more and more people starts trading an asset, it tends to become volatile. Anybody who would have seen gold moving yesterday night itself, it was almost $100 move in gold within a matter of few hours, which is 2.5%. And that happens when an asset is becoming institutionalized, more and more people are trading it. Now, just wanted to share something very interesting happening on real estate. One, you would have read the news in Financial Times about the Revolut co-founder, who's worth $50 billion. That is the most expensive fintech, most valued fintech in Western world, is Revolut out of UK. So the co-founder of Revolut is worth $50 billion. That founder is moving out of UK's residency to Dubai residency. What I'm finding in Canada, I wrote it for last years, that real estate prices in liberal areas or in the areas where there is high crime, the real estate prices are done over there. Real estate prices will only fall in wherever you have high crime areas. Simply, and because the property taxes keeps on rising. Martin Armstrong wrote in an interview, talked about in an interview, I will not buy real estate in blue states in US as migration is happening from blue states to red states. He also mentioned that Florida will replace Wall Street. The point of this slide is that governments know that it is very easy to tax immovable property. But in the case of movable property, people will just move with their assets. In an indebted world where Western world is too much indebted, real estate as an asset class is over simply because property taxes are going to rise dramatically in the coming years, and rising property taxes means real estate prices will only go down in most of the states.
Ritesh,
Except,
sorry, just getting a request if you can be a bit louder.
yeah,
Getting
okay,
a couple of requests. Thank you.
yeah, okay. So let me. Is it okay?
Yeah, probably better.
Can you hear me now?
Yes, we can.
Okay. So there are a lot of people in India who are looking to buy real estate in the Western world. My whole point about real estate is you have to buy in those states where the crime is lower, or not to buy real estate in Western world simply because governments know they can increase the taxes on immovable property and you cannot do anything. We are finding taxes in Canada going through the roof because over the last few years, property sales were so high that whatever property taxes governments were getting, they spend that money. And now you are used to spending that money because your spending is baked into the cake. But the property deals are not happening, property prices are falling, but you still want those taxes. So you are increasing the property taxes. So that is the simple reason that do not buy real estate in Western world, certainly not in blue states in US, certainly not in liberal states in Canada. Now, a lot of people talk about China, but and Western world, Western media is very, very biased against China. India also, we don't get to know too much. Just look at on the left is the top power producing countries in the world, where China was in 2000 to 2000, let's say in 2010, till 2010, US was producing more power than China. Now, US produces 2.5 times more power. Okay, I'm just being told that, that I have to use the earphones. US is producing now, China is now producing 2.5 times more power than US. Look at India and EU zone. India is now producing as much as EU. Now let's look at the right, and you will understand the size of China. Just look at the highlighted portion. Although everything is there, just look at the highlighted portion. Number of cars, China versus US. How much is China? How much is US? Number of EV charging stations. Steel, everybody know about it, so I will not talk about it. Rare earth, shipbuilding capacity, 5G stations, port cargo, engineering students. This is not even a discussion. China has won this war hands down. Americans know it. In the last 2 days, you would have seen how much Americans have blinked. For the simple reason, 20% of US tax revenue comes from capital gains. Capital gains are tied to rising equity markets. If equity markets fall, US deficit will rise. US deficit today itself is 7% of the GDP. You run a 7% of the GDP as fiscal deficit only during war times. But US is now used to running 7% fiscal deficit. So if stock market falls by another 10 to 15% and stays there, US fiscal deficit will go from 7 to 8.5 to 9%. Chinese know it. That's why US to blink. It's a matter of national security in US that stock prices should rise. Yes, corrections will happen. And that has given birth to taco trade. But if electricity is the measure of which country is doing well, you have it with you. On the right, these are the hard data. Look at the smartphones, train passengers. This country is far ahead. On a PPP basis, China is far ahead. So we had bought. This is the best way to play China. And we had picked up at the right point of time. Obviously, it took time. Any asset which I buy, I want to be lonely because there is no joy in you buying with everybody else. The asset is discovered already. It's a core part of the portfolio. Obviously, in the last 2 days, it might have taken some beating, but it doesn't matter to me. With whatever thought process I have it of China over the next few years, Chinese assets will do very well. The only problem with China is that you cannot make Chinese assets a core part of your portfolio for the simple reason that between a US and China trade war, these tensions and volatility will lead to massive drawdowns in these assets, which you've just saw in China in the last 2 days. So that's why it should be only that much part of the portfolio that it doesn't hurt you, but is there with you over a longer period of time that you're not compelled to sell it at the wrong point of time. This I had written about India in February 2025. What is the problem with India? I've just taken one slide on India because most people are not able to explain what has happened in India, why Indian markets are not, why Indian markets are not participating in this global rally. Till a year back, till a Lok Sabha election in 2024, India's correlation to S&P 500 was more than 90%. They were like locked kind of thing. Both of them used to go up and go down together. But that correlation has got broken. So let's read it about what has happened. So what is the problem with Indian equity markets? Look at the snippet below from CIC dataset. You will look at this India nominal GDP growth. You will read something like 8%. And in your mind, you don't think about it. Okay, it is 8% nominal GDP. What is wrong with that? So if in India you want to support higher valuations, you need higher nominal GDP growth. What you saw in GDP growth in India between June and December 2024, 8%. If you see India's nominal GDP growth rate is updated quarterly, averaging 12% from June 1997 to September 2024, 110 observations. Corporate profitability is a function of volume growth plus price growth. What is price growth? Inflation. So if you have 12 to 13% nominal GDP, you can support higher valuation. But if the new normal of Indian nominal GDP is 8 to 9%, then you cannot support higher valuation. Higher valuation is a function of nominal GDP and nothing else. So after Indian general elections, CAPEX gave way to subsidies. INR should have been the release valve, but for some reason, we sacrificed the economic growth to support currency by tightening liquidity. I think the monetary policy was mismanaged between June and December 2024. So fiscal tightening plus wrong kind of spending plus monetary tightening to support currency, 3 mistakes made at the same time. Nominal GDP tanked. India rarely had a single-digit nominal GDP in the data series below. To support higher P multiples, you need higher nominal GDP. INR was getting valued and markets were also getting overvalued. Who will not want to exit if they get overvalued markets and overvalued currency? Now, equity valuations are no more costly, especially taking into account that new RBI governor is now putting a lot of liquidity in the system, which will help bring the nominal GDP back to double digits. There is still some fetish about not allowing currency to find its own level. Till that happens, foreign investors will not come back, but the selling should start drying up. So one shoe of equity valuation adjustment has happened, but the other shoe of overvalued currency is yet to drop. I wrote this thing in February 2025. And after that, Reserve Bank of India has allowed currency to find its own way. I believe we are almost getting there. I also believe next year we could be back to double-digit nominal GDP growth rate. So time correction and price correction both has happened in India. Just getting there on currency, let it find its own way a little bit more, and then you will find that even foreign money will come into India. But we needed this thing simply because we were getting overvalued on valuation plus overvalued on currency because of the mistakes which we made. So how to invest in a brave new world? Pre-COVID world was all about, think about real GDP, but brave new world is about nominal GDP. Think of all the assets which do well in nominal GDP versus real GDP. Think of all the assets which do well in high cost business versus high variable cost business, which focus on fiscal policy over monetary policy, which focus on real assets over financial assets, which focus on reindustrialization versus deindustrialization, which focus on reshoring versus offshoring, financial repression over savers, regionalization over globalization, conflicts over peace, deregulation over regulation, gold over fiat currency, compliant central bank over independent central bank, industrials over healthcare, electrification over clean energy, offshore drilling versus shale, low crime real estate versus high crime real estate. I had shared this thing few months back on my Twitter, so I'm just putting it over here. This is a brave new world. This will continue till the time US debt to GDP, which is 120%, comes down to 80%. So this is a conclusion. 3% is the new 2%. Inflation is here to stay. There is no turning back. AI is a bubble, but if you want to play this bubble, then play through picks and shovels. I would say grid, electrification. There are enough themes over there which are doing really, really well and doing better than AI. In fact, if you look at Mag 7, they become so big that these companies are eating each other's lunch because there is not addressable market is not that big. So they're eating each other's lunch. US no longer willing to bear the burden of policing the world and sharing its GDP with the rest of the world. The world is rearming and military spending is now on the rise. Indian nominal GDP settling below nominal GDP, settling below double digit is not good news for Indian equities. There are better stories out there. Western world is facing sovereign debt crisis and they would be inflating away their debt. Lower bond yields and higher asset prices are matter of national security in United States. Focus on assets that benefit from nominal GDP over real GDP and pick fixed high cost business over high variable cost businesses. Gold is back in the monetary system as a neutral reserve asset. So, yeah, I'm done with my presentation.
Right, thank you for that, Ritesh. Very insightful as always, but we still have a lot more we'll
Yeah.
dig you after. All of you can please type your questions on the question window in your chat screen below, and I will try and pick some from there and keep. So, Ritesh, you covered in detail the fact that there is a lot of deficit being created across economies in the world, right? And that is also, in a way, in the US becoming the reason for the asset prices to be kept inflated.
Yeah.
So, where are you seeing the opportunities and risks associated to it? So, I see you had bought Europe because Europe was investing and expanding its deficit, and you had a view on some economies there will do well. I've seen other people also sometimes talk about Germany, let's say, for example. So, what are the opportunities related to increasing deficit and it leading to inflated asset prices? What is the shock risk related to those inflated asset prices, be it be real estate or gold or whatever, maybe Bitcoin or whatever it might be?
Okay. So, yeah. So I should have covered this thing, but I did not want to take a short-term call. Now, the best, let me answer this. The second one is easier. The first one will be covered in is covered in a lot of these slides. I do not want to go to individual countries. But the second one is very, very important. As per some papers done, and I have a 50-year-old data, the sweet spot for asset prices to continue to do well is when inflation is below 4%. Today, you are at 2.9 and 3%. So all assets can continue to do well. At 4% on inflation in US, it starts having negative impact on US equities, whereas US uh, gold and precious metals can continue to do well. So we are at 2.9%. How can we go to 4%? And I'm keeping in my eye on oil. Oil is so well behaved. They've kept it low for a long period of time. In spite of that, inflation is 3% in US. If oil prices were to rise, let's say $15 from here or $20 from here, we will go to 4% inflation in US. And at that point of time, as it is, it will be negative for US equities. Secondly, I'm keeping an eye on bond yields. Prime Minister Liz Truss had to resign simply because in UK, because the bond yield went bidless. There was no bid in the bond. So if the confidence is lost faster than what I thought on global economies, it will come out via bond market. If bond yield starts rising and MOVE index starts rising dramatically, then that is second thing. The third thing is, which people are not taking into account, commercial mortgages delinquencies are at an all-time high. There have been few fraud cases have been detected in US in the last month or so. And like brands, there is a big company which was there was a big fraud, $50 billion fraud. So there is a lot of nervousness already in US in high yield sector where these companies are not able to find liquidity or there are some fraud cases. So the corporate spreads have started widening. All these three things I am watching, closely. And, that is the reason that, the shock will come from one of these places. Now, if you were to invest in a nominal GDP, then I would say the best place to invest in for nominal GDP growth rate is actually Latin America. Over the next few years, the amount of money which will be going into Latin America and Africa will be humongous. Simply because Latin America always had resources, their currencies are cheaper, their interest rates are very high. It's just that it is very volatile to own either Brazil, Chile, Peru, or Argentina, but you have a Latin America ETF. There is one continent I am very bullish and most bullish, and that is Africa. So we have only one single asset in our portfolio, which is not an ETF, which is a equity to play only on Africa. Why Africa? The most amount of resources in the world are in Africa. China, when US was not looking at rest of the world under President Obama, China actually went into Africa and spent huge amount of money on their infrastructure. US realized it was late, but it wants that. It also wants, that resources. So US has gone big time. Russia has gone big time. And as you know, India brought Africa to G20 also. India is now going big time into Africa. So if it is all about liquidity, because I only take care of liquidity, if it is all about liquidity, then one place where most of the liquidity is going is actually Africa. But an African ETF is made up of only South Africa, and I do not want to invest in South Africa. I want to invest in other African countries. But there is no way of doing it because, yes, they have their local exchanges, but we do not invest in anything which is not listed in US. So we have a single asset, which is roughly 1 or 2% of the portfolio.
All right, thanks for that. Now there are three questions kind of intertwined, so I'm quickly going to ask all of them. They are all linked to the US, so maybe you can just leave your answer around them. What's your view on Trump presidency? Any midterms, no tangible benefit to US consumers or corporate, TACO, etc., or maybe the implications or evaluation of his tariff policies. Another is what are some possible windfalls for the US government in reducing debt or deficit, asset sales, tariffs, tax revenue, etc. Any black swan there? And lastly, if you do expect because of all these US crash, what could be a principal protection plan that you could envisage?
Okay, the first one is on the tariff part. Why is he doing all this thing? I have written a complete Substack post on why is he doing that thing. He wants to be known as the greatest president in the history of United States. And they are on record of saying that they want to cut the income taxes to zero for everybody making up to $200,000. How do you do that thing? You need your tariff revenues to come to $800 billion. And those tariff revenue can be utilized for making income taxes zero for everybody. You know that in India, we introduced GST first, and now we have cut down our taxes up to 12 lakhs for everybody, which is like 84% of the population. Coincidentally, that is the same number for United States also. So that is what President Trump, this is his last presidency. So he wants to be known as the greatest president. And that is why all this thing, he's doing tariff. Obviously, there is one more reason that they've realized that they've spent, their dollar is no more the same dollar which was accepted 20 years back, and time is coming that it will turn into paper. Before that happens, they want to reindustrialize their country. And they understand now that there are more disadvantages of having dollar as a reserve currency than having an advantages of a reserve currency. So that's why they want to, doing all these things that let tariff bring money so that I can cut down the taxes. Forget the immigration part so that the wages tighten in United States. Bring all your military umbrella countries, arm twist them to invest back into US. So by the next 2-3 years, US will start becoming industrialized. So that is exactly the same playbook they are doing it of 1944 to 52. Windfall answer is very easy. When gold was 3,000, so US has 8,144 tons of gold at $42 or $44 on their book. Unlike rest of the world, in US, the gold is with US Treasury. In India, gold is with Reserve Bank of India. It's not with Finance Ministry. So US government can actually revalue its gold at $4,000 today. And that gold will have the value of $1.2 trillion. Federal Reserve Bank can actually, the balance sheets, they can transfer $1.2 trillion to US Treasury, and it will all be perfect. They're not doing anything wrong. They're just revaluing their gold at the current prices. You take $1 trillion and you can use that $1 trillion to reduce the long-term borrowing. You can use that $1 trillion to pay for anything else. Or you just say you buy back the bonds at the longer end and sparking the rally at the bond in the long end. So you can do anything you want, but there is $1 trillion waiting for you to happen. If gold goes to $8,000, then they will be sitting on $2 trillion of these capital gains, which they can take it at any given point of time. Any other windfalls they can get? Productivity. They get rare earth metals, so they have if they get huge amount of gold deposits. But the time is running out. Why the time is running out? Because I was of the view that within 12 months of midterms, which is there in November 2026, President Trump will stop being too much volatile, simply because Republicans are on the verge. If elections are held today, midterms are held today, Republicans are on the verge of losing the House. So they will not be doing these shenanigans closer to election. That's why I believe he said the first year because people vote based on what has happened to them in the last 6 months or 1 year. They do not care about what has happened to them 2 years back. So whatever volatility you are seeing from President Trump he believes he has the leverage today, but the leverage will not be there in next 3-6 months. But I do not believe he has the leverage. What China did yesterday, accusing South Korean shipping company of selling the rare earth metals to United States, and today US markets down 1.5%. Chinese market are also down, but nobody cares about it. Chinese don't care about it because they've been diversified over the last 20 years into gold also. So they don't care about it. Americans care about it. In the next 3 to 6 months, he will start becoming more predictable. But I think the time is running out for having this, this shenanigans which he's doing it. You had a third question also. What was the third
Um,
question?
yes, that if you do expect a US crash, what is the principal protection plan that you envisage? Or if you don't expect a crash, how are you? How would you play the US markets now? I see you have bought into industrial some time back. You have not been very fond of US big tech for a while now. So I don't know
I've
if you
never
want
bought
to
it.
answer these together or separately.
Yeah, yeah. So I've never bought a US tech at all, ever, ever. I don't have any competency in which where there are smarter people than me. And it has never mattered to me. There are enough bull markets over there. Now, about your crash part, what happened in April, you saw that he turned taco trade. So I'm coming from that background that if the markets fall, let's say below 6,200, let's say below 6,000, US tax collection will go into tailspin. And US is such an economy where if the stock prices are high, then nobody asks CEOs, no board member asks CEO to go for efficiency and cutting the job force. But when the stock prices fall, then even board members push their CEOs to cut jobs. So as stock prices fall, US tax collections will fall, US unemployment will rise, and then gold will go to the moon. That's a separate thing, but everything else will fall. Everything in US will fall. But if you've seen it, he cannot stomach any corrections in market simply because US economy is nothing more than its stock market. Can a crash happen? Yeah, if there is a big oil prices rise by $15, $20, $25 overnight. Something happened on Gawar field in Saudi Arabia and oil prices rises overnight. Anything is possible. These is actually the chances of uh, volatile markets becoming volatile in going forward is very, very high. So we do run 7% of the portfolio is actually into hedges. And there is very, very good ways of hedging your portfolio in US through buying volatility, bond volatility, equity volatility. So that helped us on Friday also. So I do run that thing because I think the time is running out for him to stretch the bubble anymore. So we need some kind of washout event or a time correction or a price correction to clean out the froth from the market.
Okay, fair point. Thank you for that. Now, there are a couple of questions related to a combination of outlook, but the first one I think a lot of people on the call want your view on, which we didn't probably cover in detail, is you spoke a lot about gold. Now,
Hmm.
the silver rally has been kind of more recent, a breakout
Yeah.
after 30 or 40 years. In context of the way both of them have been rallying, I know you may not want to give a short-term view, but whatever best you can tell about both of them. Um, is it a sustainable rally? How can investors play that out? Stay put, buy in more, um, go short? What's your outlook on silver? And maybe some context on gold as well.
So if anybody wants a detailed thing, then they can, there's a YouTube video on my YouTube channel about gold and silver, but I will give over here summary. Uh, I have a 50-year data of gold where it was, President Nixon took it off from from that lock. So last two times, gold has given 8 times return from the bottom, 1980s and 2001 type, 8 times return from the bottom. So if 2013-14 was the bottom of 1045 on gold, then I'm roughly of the view that gold will touch $8 to $10,000 in next 3 to 4 years. It could be 5 years, it could be 3 years. Time is very difficult, but price projection is easier. Silver is a derivative of gold. Historically, silver has been 2% of the price of gold. Historically. In extreme bull conditions where people go mad, euphoria is there, it has gone to 3.7% of the value of gold. Today, silver is just 1.3% of the price of the gold. So if my view is that over the next 3 to 5 years, gold is headed for $8 to $10,000, and silver should be 2% average of the price of gold, then I'm very comfortable with my view of 160 to $200 on silver over the next 4 years. 4, 5, timing is not my forte. I go into history for all these things simply because these are new price levels. Whenever the new price levels are there, you go back into history and see, okay, what happened at that point of time? So I'm just extrapolating that thing, and I'm very comfortable holding these assets in my portfolio in spite of they becoming more volatile with the time.
You did say gold has a relatively a different thesis because of central banks having bought
Yes,
into a lot
yes,
and its potential future as
yeah.
a reserve currency alternate. Now, silver, apart from being a positive possibility, basis relative value to gold, what's your comment on its actual use case related to its supply? Like its
So
use case in energy or auto or whatever the use case might be. Like in India, I think a school of thought is the consumption demand should go up because of the manufacturing requirements, but the supply can be more constrained. So apart from the relative value logic, is there actually a fundamental strength case to silver prices?
So there are, yes, there is an industrial metal, and we don't have to look beyond when US has just come out with a critical material list, and they've put silver in the critical material. US putting silver in the critical material itself tells you everything. Then there's a use case of photovoltaic, you know about it, the solar panels and the industrial part. Yes, it's an industrial metal, but silver is poor man's gold. That is a reality. So if you have people cannot buy gold because it has become too costly, then they move to substitution effect. Substitution effect is like if a crop, if some food becomes very costly, then you go for the one which is cheaper. Same way, silver is like a substitution effect to gold, or platinum is a substitution effect to gold. But both of them, platinum and platinum, palladium, and silver have industrial uses also. And we are not finding supply constraint is there in both gold and silver. So what has happened in the previous two bull markets is every time the prices of gold and silver used to go up, these companies were always having a capital management issue. They always used to go for massive, increase in production, or they will go do mindless M&A. But this year, this time in this cycle, they are actually shocked at the price. The prices have risen. If the capital, if they are having better ways of managing capital, then I would say that, this time gold and silver miners have learned their lesson from the previous two bull cycle and not mindlessly spending their capital. But that time will also come where their board will pressurize them. Look, you are making so much money. Some of these large cap gold miners will be having a 5 billion kind of cash flow this year because their cost of production has not risen. Even the supply has also not risen. You are right about that. The supply has not risen. So I keep the eye on that. A time will come where you will have supply. Either the primary market underground supply will come, or maybe Indians will come and or Chinese will say, okay, here is the gold. Abhi isko pigla do, and they start selling that gold. That time will also come. But I do not see that time happening in the short term.
Okay, thanks for that. You did mention that China has a long-term roadmap to it, but for various reasons, it cannot remain a core allocation for investors because of its
Yeah.
challenges that they themselves are not very particular about keeping the markets high, like in
Hmm.
the US they may have, right? You also told us about AI having a great future and stable coins, stroke Bitcoin having a great future as well, right? Now, do you think between China, AI, Bitcoin, these will, for different reasons, remain non-core assets which one needs to have a leg into in their portfolios? Or do you see them becoming mainstream sometime in the near future, which somebody cannot miss? Like Bitcoin, say for example, right? It has eventually come up and become really right up there on a high. I'm not
So
sure
let's
if
start
they
with
can be
Bitcoin.
played at mainstream investment ideas yet, or they are still satellite investments for you.
So look, we played Bitcoin when it became a security. We saw in 2004 when first gold ETF was launched and massive institutional money came into gold, GLD ETF, and it was a bull market for next 2-3 years. In 2024 January, the first Bitcoin ETF was launched, and that was the first time Pinetree bought Bitcoin in ETF form. We never buy wallet and all those. We will never go. Just we bought it because we have seen anytime anytime an asset converts into an ETF, there is an institutional capital comes into that thing. So we played beautifully for 9 months, 12 months. We made our money, we got out. The problem with Bitcoin is the biggest, so I'll give you some number. The biggest drawdown of gold in the history has been from the top to bottom being 22%. The biggest drawdown of Bitcoin in this cycle, we have only a 12-year history, is 70 to 80% three times. How do you play? How many of you will be willing to hold an asset which draws down 70 to 80%? Yes, can you see from a risk return perspective what I'm talking about over here? That it will take, how many of you will be having a portfolio if you might believe in Bitcoin? And how many of you have seen that gold does not have any promoters? But for Bitcoin, you have so many promoters. It's like people are pushing Bitcoin to you. I understand stable coins. Stable coins is required by US because it wants to have its own trading system, global trading system, where its partner, its military umbrella, all will trade in the stable coin system, because US has no control over its printed US dollar, 50% of them outside the US jurisdiction. US says, I don't want to do that thing. I don't want my US dollar to be outside my jurisdiction. So anybody who wants to trade with US, like today, you know that China is sending through Mexico or Vietnam, it's sending to US the same stuff, right?
Yeah.
But once you have the stable coins and all, US will be having much more, control over its money supply. Plus, it will have somebody to buy its treasury bond where the supply is increasing. So I understand the user case for stable coins for US. Bitcoin, no, I don't understand. It is just create too much volatility for the portfolio. Even if you take 3-4% of the portfolio, it's just too volatile.
Fair point. A question on, if you could briefly touch upon, maybe not in too much detail, what are still some outstanding risks of the Ukraine conflict or the Gaza conflict or something new which may brew up in the Middle East?
Yeah. So look, Gaza, everybody wants to reconstruct it. There's a lot of money to be made in reconstruction. There's not enough money in war. There's more money in reconstruction, and those things goes to Western world countries only. So it's a very interesting thing. So Gaza, everybody will be falling over each other to reconstruct. The problem in Ukraine and Russia is winning this war. Everybody knows it. You cannot fly a Tomahawk or a Patriot missile without a Chinese rare earth magnet. Russia is outproducing NATO by a factor of 10. NATO, the entire NATO put together. Russia in this thing for slow burn. Now, I'm not siding it, but please tell me, is it okay if Russia gets into Mexico, has a military base in Mexico, will US allow that thing? So why is it okay, which was supposed to be a buffer state, which was never supposed to be a part of NATO, is allowed to have become a part of NATO, which is a buffer state? Ukraine was never allowed to be a part of that thing. Americans went back on their promise. And now it is not about thing. People, like, if you see, US has always invaded those countries which have resources. The most amount of resources in the world put together are in Russia's worth $70 trillion. It's a prize. Russia is the prize. What does Europe has? Nothing. Barren land. Why would Russia wants to invade Europe? It's an existential threat for Russia. But the Western media will not tell you this thing. So this war is a slow burn. Gaza was easier. You have to bring Middle East together. And then you can give contracts to Saudi Arabian companies, Qatar, even some of the subcontracts will come to India also. Everybody's happy. I've just read Brookfield is getting some kind of contract somewhere. So everybody's happy over there. But Ukraine is not that easy.
Interesting. Obviously, $1 million question coming in. Now, you have ability to invest across the world at ease, right? If today you were to construct on your portfolio, your own portfolio, and it might very well mean a construct of your fund as well, right? What would kind of be your mix between what global markets, what amount of India, what amount of commodities, or whatever thesis you're feeling strong at this point of time? And obviously, if there is a thesis to be a little, benign to negative on Indian equities for some time.
So US is 70% of the global market cap. But US is only 25% of the global GDP. I believe over the next few years, this gap will close down. Today, the portfolio, you can, Gaurav, you would be having
Sorry,
a
we can't
bit,
hear you again.
sorry, US is 70% of the global market cap.
Right.
But US is only 25% of the global GDP. So there is a very big dichotomy between US market cap and US GDP. I believe over the next few years, money will simply move away from US, or incremental money from global pension funds will not be invested in US. If I have to construct my portfolio, and that is the portfolio today, which you can get it, our fact sheet will be released tomorrow. It's between 30 to 35% commodities, which will include, which includes agri commodities, which includes oil and gas, which includes all the precious metals, and which includes uranium. 25% will be 25% will be US. Up to 25 and 30% will be US. It will not be more than that. Rest will be rest of the world. There are enough good stories over there. You can find enough good stories over there. Regarding India, we had taken a call that we will not invest anything in India from global macro, because it can be considered as round tripping of the money. Having said that thing, I believe over the next few years, Indian markets will be headed for, you will easily get a, not a 15 to 20% return, but easily 12 to 15% return in Indian markets over the next few years. But my thesis is money will not be made in the benchmarks. Our benchmarks in India are made up of yesterday's winner. Think about our benchmarks. At one point of time, 55% was in financials. Between services itself is 70-80% of the benchmarks. Whereas the future of India is not in services. You can see that thing. Where even our government is pushing money into those sectors where the employment creation can be high. Those employment creation is not into the services anymore. So more money will be made outside the benchmark. And I have only three theses for the last 3 years. Nothing has been changed. One is electrification theme in India. Second is defense tech in India. And the third is financials, but not the ones which are not under regulatory overreach. Something like your business, where you're not concerned about the regulator, but the big banks are now put in a black box by regulator. Anywhere globally where the regulator is overarching, you cannot buy that theme. Anywhere where the regulator is deregulating, where the government is saying, this is my priority, that is the theme. Government is the economy. Forget about the private sector. In this brave new world, government is the economy. Government is deciding the winners and losers. Government is allocating and reallocating the capital. Government is saying, I do not like this sector, I like this sector. So they will take away money from this sector to give it to this sector. Whether that is right or wrong, I do not get into that. But this is the brave new world. Think everything from the government point of view, and investing is very easy.
Great, that's very helpful. I think that's almost the completion of questions from people on the call as well, and mostly from me as well. So thanks a lot, Ritesh. I think that's been a great input across a variety of events, geographies, variables, and commodities, etc. We have good clarity there, and obviously we will leave it to the best. That is you to manage it. You've done well in that over the last 3.5 years. You've shown that you have been able to move across all these themes at the right time, and like you said in the deck also, the real charm is in being a little ahead of the curve. There's no point following the crowd because that's not when you make the best of the money. So thank you again for your time. Thank you everyone for joining in. We had promised you around in your hour and a half. I think we are almost at the end of that. Since I don't see any more questions, and I also have kind of had Ritesh talk about whatever I had on mind. Ritesh, unless you want to add something, we can call it close to the conversation.
No, thank you. Thank you for everybody who's on this call.
All right. Thank you so much,
Yep.
very much, guys. We will circulate the recording to you as well. If you want to go through it again, you will be able to look at the slides as well. There has been a couple of messages on people wanting to look at the second last slide primarily. That was an amazing slide put together.
This one.
Yes. Yes,
Okay.
very, very interesting slide. I have personally not seen such a diversified slide before. So there are quite a few requests on having a look at this. We will send the recording around so you will be able to see this in proper more detail and maybe assimilate it more. Thank you so much, everybody. Have a good night, and Vitesh, a good day to you.
Yeah. Thank you. Thank you,
All right.
everybody.
Thank you
Bye-bye.
very much, guys.